Hey folks, it's Dave Burrows. It is Sunday afternoon at about 5 o'clock. I thought it might make sense to just record and send out a short message as it relates to markets. Thursday, Friday were two tough days. The tariffs that came out Wednesday night clearly were more aggressive than really the top end of the range of estimates as to what might happen. And I think a lot of folks got caught off guard. Investors have been trained over the last few years to sit tight and be passive. That's not really our strategy. But I think that given the news on Thursday of a 5% down day, probably had people as attention. And then Friday, it opened a lot weaker. And so people probably sat and wondered what to do. And after 2 days in the market down 10%, my guess is there are some folks at home this weekend who will come back Monday morning thinking they've got to do something to be a little bit more defensive. This is where process comes into play. It's where having a selling discipline is very useful, because as we came into the end of last week, we came in with a very significant cash weight in portfolios. Frankly, we had more cash by the end of Thursday. But I just wanted to quickly run through sort of from the top kind of what we see going on, because it's obviously, an unnerving period for investors. You can see on this very long-term chart that over the last 2 months, the S&P's come down. It's down about 9.5% in the month of April. It's about 13% off the highs. It's not an unusual thing. It happens. We remain above this 200-week moving average that we talk about each week on our weekly webcasts, and we'll be watching that level. But so long as we're above there, we're in a structural bull market. There's lots of uncertainty. Economic uncertainty has been spiking. We talked last week about the trade policy uncertainty. That's certainly unnerving. And when you look at the short-term picture of the S&P, we made a high here in the beginning of the year, and we've been coming down since then. Now, in the end of January, our models that track breadth started to show weakness, which means a couple things. It means we stopped putting on new positions and we raised some cash. We came down through the 50-day moving average and the market tried to rally. And then last week started to weaken again, and then 2 bad down days. So first of all, this is the trend line that's been in place going all the way back to the beginning of the bull market in October of 2022. We're about 7% above that trend line. If we look at the weekly chart, you can see that 200-week moving average just below. And you can see, it was a very difficult week last week. We did have very high volume. That tends to be showing perhaps some capitulation. It was the biggest volume day for the NYSE in history. And probably because people are concerned about the impact of tariffs. Now, going into the tariffs, the expectation was that at the high end of the range, it would impact GDP by 1.6%. When we look at the NASDAQ's been lagging since June of last year. NASDAQ actually now has traded down through the trend line that had been in place all the way through the bull market. Now, over the last 6 months, we've gone from, I think in June of last year, we were 30% technology. We came into last week at 1%. I think we've been at 1% technology for about a month. And clearly the NASDAQ is the weaker market. I think it's down 22 or 23% from the highs. So this is a market that's having difficulty. A couple of takeaways. One, big high volume spike to end last week. When I look at relative strength, it's now traded down to oversold territory. Doesn't mean it has to stop going down, but it does mean that you're getting to extremes. And when we look inside the NASDAQ, the semiconductors, which have been very weak, have sort of round tripped. Now, about 6 months ago, we put this up to say when semiconductors get stretched way above the moving average, ultimately, either they correct in price down toward the moving average, or in time, as they did in 2018. But they can correct a lot, which is why we exited our positions. And here we are, having gone from stretched way above the 200-week moving average to right down to it. So maybe it is that we're still in a bull market for technology, and that we've corrected some excesses. We'll see. If we break the 200-week moving average, that'll tell us something different. But we just got to keep on assessing these things day by day. And fortunately, at this point, we don't have a dog in the hunt. When markets go through corrections, it creates opportunities. If things can get turned around, we can put some positions on. But we're not there now. Everybody looks at things differently. We come at things tactically. Our job, I think, is to be in market leadership. We use the tools that we have to watch for change, like semiconductors getting into difficulty. In the absence of leadership, our tendency is to sit on our hands. It's okay to be out of big parts of the market. We can be tactical. Now, a few weeks ago, the percent of stocks in uptrends, this is all US stocks, started to fall from 50%, and that number has been getting smaller. When breadth in the market starts to contract, that tells us to play defense. You know, it's okay not to be participating if your number one job is not to lose too much money. So when breadth starts to deteriorate, we get more cautious. We raise some cash, we tighten up the stop losses we use on our positions, and we continue to assess. We don't put any new positions on. So over the last few weeks, we've talked about the fact that we're building our farm team. We got a lot of great companies that at some point we'd like to buy. Ideally, we're finding companies that are good getting better, where the prices are holding up much better than the market. Market stress highlights the strongest companies. And the ones that hold up better than the rest often are the ones that lead in the next leg of the market. Last Tuesday, we highlighted that our long-term indicators were all negative, and the percent of stocks trading above their 50-day moving averages were largely sloppy. If we look at it in context, the percent of stocks trading above their 50-day or short-term moving average, going back over the last few years, right now we're at 10%, or a little bit less, 9.7%. In the sell-off in the summer of 2023, we got down to 12%. That was a low. In the bear market through 2022 in October, we got down to 6%. That was a market low. And I can show you other examples back further in time, but when you get to a low single digit, it tends to be that you're getting there. Now we can get there and stay for a bit. When we look at the percent of stocks trading above the 150-day moving average, or a long-term measure of trend, in the US today, it's 13.5% of stocks trading above their 250-day moving average. Again, in 2022, in October, it got down to 12%. In the COVID lows, it got as low as 6%. In the 2018 taper tantrum, a period I prefer not to think about, it got to 8%. So again, we're getting there. When we look at the sector work that we do, we always say that if you plot all the sectors based on the percent of stocks in uptrends, with the strongest groups at the right side and the weakest groups at the left, we're getting pretty stacked up on the left-hand side. The average sector, only 22% of stocks are in uptrends, down about 7% on the week. So lots of stuff getting hurt. Things that stand out to me, gas utilities, that's pipelines. Well, we got some of those, and they're performing well. Precious metals, next best group. I think we've got 13% precious metals. Insurance, well, this has been our biggest weight in the firm through Fairfax and Intact and others. The banks, the green ones mean they're strong relative to the market, and the pink ones mean they've been relatively weakening. So things I take away from this, the sector charts are getting sold out. The groups that we're focused in are stronger. Let's look at volatility. During a bull market, it tends to be that you stay within a tight range of volatility, sometimes marked with interruptions, but very quickly back into the box. Friday, we closed with volatility up at 45. Something's changing. And we have to take notice of that. Now, when VIX ultimately spikes, like it has on this number of other occasions, 2009, 2011, 2015, kind of was rolling over, 2018. Again, it tends to be you're getting toward the end of a sell-off. Now, it can get worse, but when we look at the data, when VIX gets above 40, it tends to be that 1 year, 2 years, 3 years, 4 years, and 5 years out, market's higher. Like sell-offs create opportunity, especially if you've got cash. So things that I think stand out to me, we like to see extremes. On Friday, 74% of stocks went down 2 standard deviations in price. In other words, the price move down was greater than in 99% of occurrences. So you got to go back to March of 2020, the worst point in COVID, to see that. Now you saw it for 2 or 3 weeks. We often find that at market lows, or when you're getting near lows, there's a lot of put buying, people trying to buy puts to protect their portfolio. And we saw a spike in puts last week. Maybe it can go higher, but we're getting there. There was a lot of people on Friday buying inverse ETFs, ETFs that go up when the market goes down. Well, that's as big a spike as I've ever seen. And then we look at the number of companies that were making 20-day lows. So lows over the last 20 days. 77% of stocks made a 20-day low. In 2022 at the market low, 86% made a 20-day low. Now, it's always interesting to look at how markets bottomed because we got to look at how ultimately to put money back to work. Very often when markets make a first low, you get the most emotional low, the bang. And then a few weeks later, the market will retest the lows. And when the market's bottoming, fewer stocks will make a 20-day low because the market starts to sort the good from the bad. So 77% of stocks on Friday made a 20-day low. Maybe it'll go higher. What are we watching for? We'll watch for a significant bounce at some point. Maybe it's tomorrow, maybe it's later in the week, maybe it's a week later. We'll wait then for a follow-through day, a second strong day, 4 days out, because one day doesn't mean anything. And then most often, you're going to get a retest of the lows, and we're going to want to see fewer companies making a 20-day low. Let me give you an example. In 1998, there was a very famous hedge fund that blew up called Long-Term Capital. It was run by a bunch of PhDs and Nobel laureate winners. When the market made its first low, down 21%, 74% of stocks made a 20-day low. When the market retested the lows a few weeks later, only 50% of stocks made a 20-day low. That's the market starting to heal. That's what we want to ultimately see. In 2011, big sell-off. Market goes down 21.5%. 98% of stocks made a 20-day low. As the market retested the lows, fewer companies made the 20-day low. So things that we care about, when you're ultimately going to get a low, and we're not there yet, I don't think, we're going to see extremes in sentiment, right? The VIX over 45, we're there now. Lots of puts being bought versus calls. That's pessimism. Big inverse ETF buying. That's pessimism. We're getting extreme sentiment. You get an indiscriminate selling, right? 70% of stocks or greater than 70% of stocks making a 2 standard deviation move lower. Well, we got that on Friday. S&P volume was over $100 billion on Friday. That's indiscriminate selling. That's when you're selling anything because you want to sell what you can sell. And then when you get capitulative price action, where the 20-day lows are above 70%, or fewer than 12% of stocks trading above their 50-day moving average, check, check. So we are at extremes. It can get worse. I'm certain there's going to be people coming in tomorrow morning thinking, I got to sell some stuff. We're fortunate. We've got a lot of cash. We've got lots of flexibility. And then we'll watch a bottoming process. There's no race. It's more important to us not to lose money than to be the first ones invested. We'll take our time, but we are certainly focusing on trying to find where the opportunities will be at some point. Now, as it turns out, we said many weeks ago, this new Trump administration is going to be full of banging and loud noises. And the market's going to have to deal with it. Markets don't like uncertainty. The US dollar started to weaken over the last while, and global stocks started doing better. Well, surprise. Global investors have been buying US stocks for years because their markets weren't performing well and their currencies were weak. Now, for instance, Japanese yen's been appreciating and the Japanese market's been doing well. Some of that Japanese money is leaving the US market and coming back to their home market. Same thing's happening in India. When you come out of a long period of sideways and you start to move higher, that's a new bull market. We're in the early stages of new bull market in Europe, and it's not going to go straight higher. But my guess is, given Trump's policies, there's a lot of global investors who are overweight the US and have been for years that will be more than happy to start taking their money home. And that's why we've been focused on global stocks over the last year. Even China, with all of the noise over the last couple of weeks, has had very little reaction in the market. Frankly, if we look around the world, there's a lot of countries that are in clearly defined uptrends. And the US right now is not. The TSX is in an uptrend. We're trading above rising moving averages. And yes, we're pulling back. We're down about 11% off the highs, better than the US, and in par with the rest of the world. US is underperforming the rest of the world by the most since 1988. TSX relative to the S&P, this is to Friday. TSX has started to outperform global stocks relative to the equally weighted S&P. This is the last 5 months, including Friday. So maybe the opportunity coming out of this is being able to put more money in global markets on their first little pullback. Something to think about. Valuations for global stocks are very cheap relative to the US, and Canadian stocks are cheap relative to the US. If tech isn't leading, we don't have to be in the US. Okay, let's look at fixed income just quickly. One of the reasons we think that Scott Bessent and Letnick want to go through with these tariffs is they want to try and weaken the market. They want to make people afraid, get them to buy bonds, move interest rates lower so that it's easier for the US to refinance their debt. Not really seeing a sign of a big drop in rates yet. That's 30-year yields. 30-year bonds have bounced a bit, but we're still trading below the moving averages. But clearly investors are nervous because investment grade bonds, this is the LQD ETF relative to the 5 to 7 year US Treasury bond, has started to outperform. So they are accomplishing creating concern around the economy to potentially slow things down. We're also seeing high yield bonds start to underperform investment grade bonds. So that tells us that quality at this point is important. Earnings quality is important. Credit quality is important. Safety is important. And look at gold. Gold has been marching its way higher. It pulled back a little bit at the end of last week. That's pretty clearly defined upward price trend. So I do think it's relatively important that in 2000, when tech stocks rolled over, gold started to outperform and outperformed for the next 10 years. From 2011 to 2022, tech outperformed and gold went through a bear market, went through a bottoming process, and now gold has been lifting relative to tech. So look, I think this sell-off in US stocks, broad-based, has one meaning. I think sell-off in tech and relative underperformance since June of last year has another. High multiple stocks do well when rates are falling and there's disinflation. Gold does well when there is inflation. I think we're in a more inflationary world, and so we hedge the portfolio owning gold. So this is the shares of Agnico Eagle. We could put up Kinross. We could put up Alamos Gold. very clear uptrends. Yes, they pulled back on Friday. Everything pulled back on Friday. It's trading better than 97% of companies in the S&P. So we're in an early stage gold bull market, and gold bull market's going a long time. So big takeaways, commodities are outperforming. That means we got to think about inflation. The market is very selective. Lots of sectors are sloppy. It means we're in no rush to put money to work. If we look at the portfolios, here's how we sit. 20% cash, 15% government bonds, and down the list, another 8% in corporate bonds. So 23% short-term bonds, 20% cash, that's 43%. That is flexibility. We have energy as an inflation hedge, and we have gold, 12% in the portfolios as a safety hedge. When we go through the sectors, the weakest sector is technology. It's 1% of the portfolio. We came into last week in exactly that position. We have almost no consumer exposure, 2%. And that's because we do think tariffs and inflation make it tough on consumers. If we break it down by mandate, in our equity mandates, 50% cash and equivalents, and about 7% gold. In our income portfolios, 35% cash and cash equivalent, 13% gold. In our balance mandate, 18% cash, 6% miners, 5% physical gold, and 40% corporate bonds. Portfolios look really different than they did 8 weeks ago. But I'm really pleased by going step by step. By the time the market is in real difficulty, we've got lots of flexibility. And here's why it's important. Every year, the market pulls back. Every year. The average is 13 or 12 or 13%. Sorry, 14%. What comes after is returns. If we look at the two really bad days in a row, you go back to 1950, 1 month out, 3 months out, 6 months out, 12 months out, market's higher. Now, we're not making any bets. We're going to follow our process. If we see our breadth model start to turn up, or if we get a good day and a follow-through day 4 days later, we'll look at putting some money to work. But I guess that the news flow is going to continue to be bumpy. In the bigger picture, we're still in a bull market, but we're certainly getting tested. If things get worse, we'll get more defensive. Our history is that when things get sloppy, we have a tendency to mute the decline. And we're in a great position to do that. I think our average account year to date now is down about 7%, with the market down 13 in the S&P and down 21 or 22 in the NASDAQ. I hate being down money, but I like the fact that we've got lots of options. We're going to get more information tomorrow. The future is going to start trading shortly. I'm going to try and get this video out so people get it before tomorrow morning. We'll take the information as it comes. And as usual, we'll be back on Tuesday morning with Tuesday afternoon with an update. I hope everybody's had a great weekend, and I look forward to seeing you all soon. Thanks so much.